When I first heard of the stock market, I thought it was a place where we had to get up earlier than everyone else and find these hidden stocks no one's ever heard of. It felt distant, complicated, and something that really wasn't for me. But once I learned how it worked, I realized it was pretty straightforward and anyone could take advantage of it. Let's go back to the 1600s and look at the first example of a stock market. The Dutch East India Company needed money to fund their long and risky trading missions. They were sending ships across the world to trade spices, silk, and other goods. But those trips were expensive and they didn't have the money to complete those missions. So they came up with a new idea. Let everyday people invest in those missions, and in return, those investors would get part of the profit that the company made. As more people invested in the missions, the company was able to go on grander voyages, making more profit for themselves and for the investors. In doing so, the Dutch East India Company unknowingly made the first stock market. Today, the modern stock market is much more complicated than its original incarnation. So how do companies and investors use the market today? Let me give you an example. Let's say I start a company called CoolCup and it's doing great. But to grow faster, open stores, scale production, invest in development and research, I'm going to need more cash. So I decided to take CoolCup public through an IPO, which is also known as an initial public offering. And that means I split the company into a bunch of small shares. These shares can be bought by the public. When you buy a share, you're literally owning a part of that company. The money from the public buying those shares goes directly to the company, and that money could be used to open new factories, develop better products, expand internationally, or even pay off debt. So your investment is helping that company grow in real, measurable ways. Once those shares are available to buy and sell on the open market, their price is controlled by supply and demand. If a lot of people believe in CoolCup and want to buy, the demand will rise. Maybe CoolCup just released a new product, or a celebrity endorsed them on social media. These kind of moments can spark excitement and interest investors. And since the number of shares is limited, the demand pushes the price higher. Let's say you buy one share of CoolCup at $10, and through the years it rises to $20. If you sell at $20, you've just doubled your money. That's how investors make money, by buying low and selling at higher prices. Some companies even reward their shareholders for just owning the stock. This is called a dividend. It's like a bonus payment, usually paid out every few months. It's a way for the company to share profits with you. On the flip side, if people lose confidence, maybe sales are falling or a new competitor shows up, demand drops and the price will fall. It's a constant seesaw of what the people think the company is worth based on internal factors like earnings reports, product launches, or CEO changes, and then external factors like interest rates, global news, or trends in the industry. The market moves fast and prices bounce around for all sorts of reasons. But over the long run, good companies tend to grow in value, and their stock price reflects that. That's why long-term investing usually works better than trying to guess at short-term moves in the market. Thanks to the internet, investing isn't locked behind some rope anymore. With a phone and just a few bucks, anyone can start investing today. Apps like Robinhood, Fidelity, and Webull make it easy and accessible for everyone. And the earlier you start, the more time your money has to grow through compound interest. So yeah, at first the stock market might seem intimidating, but once you break it down, it's just a system for sharing ownership and fueling growth. And it's one that anyone can be a part of. You don't need to be rich, you just need to get started.